Good morning, everybody, and welcome back to Schwab Coaching. We are down to business today on getting started with options, following up to last week's class on call options. Today, we are talking long puts, that is to say, buying put options, and where do we consider doing so? What are some of the circumstances in which we would consider such a transaction, such a trade? And we're going to dive in today and try to give you that foundational understanding of put options and the scenarios around which buying options are, how that impacts our underlying portfolio and what have you. So a lot to get to as usual today. We're also going to follow up very briefly to the conversation from last week where we did long call options. I want to look briefly at the position we took as an example trade last week and talk about that for a second, and then we'll get into things looking through all the details here on puts and a number of slides and what have you. So plenty to get to. Take a minute, say hi to my friend James Boyd there in the chat. He's going to monitor things for me today, get to questions that are on topic and that I'm unable to get to in the moment. But please feel free to post those questions for the duration of the segment. We will go about 45 minutes in total. I'm certainly happy to have you here, happy to hear from you, so don't hesitate to post those questions in the chat. I see a lot of familiar faces there, of course, a couple of whom came out to the Denver event. Thank you so much for joining us in Denver. And I'll just mention, if you're finding this class today for the first time, the one opportunity we have to bring you to is the reminder that this class, these can be an extension of what we do in the live events, but the live events can also be an extension of what we do here. So if you've not yet had an opportunity to join us for one of the live events, well, I'd love to show it to you, but my coaching channel doesn't seem to want to offer it here. Let me try one more time. Check out schwab.com/coaching, everybody. Looks like it's not going to load for me, so I'll eliminate that. But I just want to mention it because, we offer both the introductory levels to technical analysis as well as options and advanced options also. So check that calendar out if you're looking for that opportunity to come out and get to see us face to face and extend that learning process for yourself. We invite you to do just that. And if you're not already doing so, follow James and me on X. James is available, James Boyd CS, and I am, of course, Kevin Horner CS. We try to post for you there throughout the week. So it's a great way to engage with us coaches outside of the classes that we host. Now, let's get to the disclosures, everybody, and then we'll jump into the fun stuff for you. Remember that our conversation is exclusively for your information and your education. We do not make recommendations. We do not endorse a particular strategy or approach to trading the market. Remember, additionally, that options carry a higher level of risk. These are not appropriate for all investors. You do need to be familiar with the characteristics and risks of standardized options. You can review that document pretty easily. We can provide you a copy if you give us a holler to our service line. We're happy to do that for you as well. And of course, today we're going to be looking at some examples of trades you might consider. Please recognize that these are just that, examples for educational purposes exclusively, not to walk away with as a recommendation, of course. So today, our agenda, we're going to define put contracts. We will determine some potential entry signals and expiration dates, strike prices, things about which we need to be aware as we work through that thought process. We'll discuss some trade management as well, techniques for doing that, and place a couple example trades, hopefully more than one. We'll see how that plays out, how much time we have. As I mentioned, I am going to review a position we put on last week when we talked call options. We're going to work through a few slides to kick us off. And then when we get to our example portion of the discussion, probably in our final 15 to 20 minutes or so, we'll start by reviewing that trade we placed last week and just talk a little bit about how that went for us. So with that, let's move through some of these important details. So what does it mean to be a put buyer? Well, the reminder is essentially that one, when we're buying put contracts, commonly it's thought of as a protective measure to underlying equity position, equity or ETF. Now, today we're going to be talking exclusively about equities, of course. So think about the underlying contract as to how it reflects ownership or an ability to protect ownership in the underlying stock. And much like a call option, of course, the put option gives the holder of the option, the individual who buys this put, the right, but not the obligation, the right to either sell that put option in the open market or exercise that put option to sell stock at the strike price designated by the contract itself. So, reminder, of course, buying contracts, whether it's a call or a put, from a basic understanding of options, when you are the buyer, you have the right, but not the obligation. That means that it is your decision how you choose to exit those trades. When you sell options, you are then obligated to take some action. We're not talking about that today. So just understand that our focus will be on the long side, the ownership aspect of put options here today. So what's our goal? Well, typically it's one of two things. We're looking to either benefit from downward movement in the stock's price, or we are working to limit risk associated with those underlying securities. And again, you have the choice. You do not have to be an owner of the underlying stock in order to own put options. It is true that you can be a buyer of put options solely for the purpose of speculation, meaning simply you believe a stock that you do not necessarily own is going to trade lower, and you would like to speculate to that extent. You'd like to buy the right to sell the stock at a given strike price. And if the stock drops lower than that strike price or lower than it is at the time that you acquire that put, well, then the odds favor you being able to sell that right at a time down the road for a higher price than which you paid. So very much the opposite, of course, of buying a long call. Okay, now let's look at how this appears when we start talking about the risk mechanics and how this looks from a standpoint of benefits and risks and what have you. And that's the risk profile we see here. So the potential benefit. So why do we buy put contracts? Well, the maximum benefit is that you can sell stock at that strike price and you can reap the total profit by looking at that strike price and the difference between it and zero. Now, remember, with a put option, that's the most you can gain, right? Is the difference between the strike and zero. The stock can't go lower than zero, and majority of the time, of course, stocks don't go to zero, but it does give you that viewpoint. That's the idea as to your maximum gain scenario. So a big difference in terms of how we view call options, which have, in theory, unlimited upside when you buy a single call option, because we never know how high price can go. It can always go to a true theoretical unlimited price level, but put options by the opposite side can only drop the difference between the strike price and zero. Now, time frame, again, this becomes kind of important for us. As traders, many traders consider incorporating put options when things are a little uncertain. The reminder offer today as it relates to puts is to remember that you're spending money. When you place a long put option, when you buy a long put, you are spending cash from your existing portfolio to do that. That means if you are buying a put to protect an underlying stock, well, then you are adding to your cost basis. You are increasing the amount of money you have devoted to that position. Okay, so you have to be thoughtful of that, and you can't simply own a put in perpetuity. Some traders may choose to own a put for a longer window of time, but it's not likely tied necessarily to the idea that they want to own this protection for an extended period. It's much more likely that they just feel as though there might be a trend in place The reason I say it like that, everybody, is if you think about buying puts and spending money, it makes sense to protect against a known scenario like an earnings window, for example. And some traders would absolutely do that, buy a put in advance of an earnings announcement as protection. But it does not pay to be that way or to spend money on a week to week or month to month basis if those contracts are going to essentially expire worthless, right? Because now you're increasing your cost basis numbers of times over the year, for example, and can absolutely have an impact on your net profit situation for your underlying stock. Much like call options, when you buy an option, a put option, your maximum loss of the put is no more than what you spent, right? It's up to the amount of money that you spent, the debit that you paid, that is. And of course, time decay will work against the owner of the option contract. When you're buying stock, when you are the owner, the long call or long put owner, decay works against you. And when we sell options, decay works for us. So just keep that in the back of your head as one of those bullet points associated with, understanding really the mechanics of being a long contract owner versus a short contract owner, or the buyer of options versus the seller of options. Okay, I see we've got a note about a survey in there. Thank you, Eva, for mentioning that. You all know I love hearing from you. I really appreciate the feedback and insights that you offer. If you have the 60 to 90 seconds to devote to it, you can click that link and it'll open a browser window next to this presentation window, everyone, and you can get to this post-show. After I've given you something to think about, hopefully then you've got some ideas for me. Let me know how we did today. That would be greatly appreciated here. Okay, so when thinking about stocks, let's think about stocks that might be appropriate for put options. A couple of things for consideration. Again, yes, we can think about these stocks that are in our portfolio. Maybe we have run ourselves into a zone of potential resistance. Maybe we have done so in a window commensurate with the earnings announcement coming up for the stock that we're holding profits in. And then it can make sense to be an owner of a put if you're buyer of the put as we are approaching that risk event, right? But if you are simply looking to participate in downward pressure on an underlying stock, whether you're the owner of it or not, you might look for stocks that are already in a bearish trend. That is to say, lower highs and lower lows rather than the bullish trend of higher highs and higher lows, of course. But it would also be important to consider stocks with a higher volume of trading, not to mention stocks whose options series reflect a higher trading volume as well as open interest. These can be things that can provide better liquidity to the trader of these option contracts. Additionally, options with a tight or a really snug, if you will, bid and ask spread that makes it such that the contracts are going to be more liquid and your price range won't be hurt by the big wide spread. For example, if you've got a contract that is bid at $2 and asking $4, well, it's essentially the market maker is going to try and get you to come to them, right? They want you to pay the $4, where we want to find ourselves somewhere in the middle. When we have these wide bid and asks, it leads to a more difficult option trade because you need a bigger move to validate the improvement in price action on your contract. And this is the case whether we're talking long options on calls or puts. When you're thinking about being the owner, it certainly makes a lot more sense to trade options with higher volume, higher open interest, and tighter bid-ask spread. So that doesn't fall into a vein that says that's how you handle puts only. That's how you handle puts as well as calls. Those factors are very important. So, downtrending stocks, stocks that are breaking through a major zone of potential support, that can be momentum based moves. Stocks that are rallying into resistance and failing can be indications of early entry to continuations of a downtrend. Those that maybe are in bear flag patterns, where we're looking for a trade below the low of a high day, the opposite of our so-called hold moves, right? So these are a couple of the examples for some semblance of consideration. So let's take a look at one possible example that I've got in the slides here that will offer a few different instances where a put trader could have found themselves establishing an initial transaction. So if we look at this chart, we see that we have a stock in the midst of a downtrend. We have the upper left working in terms of prices to the lower right. Now, if we start over here on the upper left, we've drawn in that so-called bear flag scenario, the idea that we have found a short-term low. And let me just try and draw some of this in with all of you here. So we found a short-term low right about here. And then we moved off of it for about 3 days and made our move to the upside. We made yet again a lower high, lower than the last highs, right? And that lower high then got pushed further lower. So we had a potential entry on this day here based on the fact that we closed below the low on this day. This day here is our high day in this brief, albeit very brief rally, right? So that brief rally got denied. And if you were a bit of an aggressive trader, some would say that the first time that you close below that low of the high day becomes your potential entry. And of course, every example we're going to show you in a slide deck like this is probably based All right, everyone. Seems we are back. Thank you for your patience. I was referencing this initial move, right? Below the close below the low of our high day, and the potential that a trader might start a bearish position based on that first trade. And I want to just mention a little bit further that a trader could start like that, right? But we also might wait until we trade through the most recent low in our pullback, which would be a more continuation based move for the trader. Either one of those can be initial entry points. I'm bringing it up as a reminder of simply trade management. How do some traders go about that process? Be thoughtful. We can work with multiple entries when we're talking underlying equity shares, but you can also do the same on your option position. So, assuming we're talking a comfortable amount of dollars devoted to our trades, whatever it is you're thinking about putting to work in a bearish trade, some might start with, say, 25% based on that first close. Some might start 100% based on that first close. It all comes down to your level of comfort, your level of willing aggression to the trade. Some would start with that first and say, I'm going to take that small part. And then as soon as we make a lower low, I'm again going to try and add to that trade. So you had another shot perhaps right about here, but there have been a number of instances like this in this particular pattern, right? We've had not many bounces in this pattern, and the bounces we do have are taken into zones of former support, now potential resistance. And so, if you're trying to justify staying in put options for extended periods, this pattern in here has provided you with a multitude of reasons to do just that, right? You had resistance met in this area here, resistance met in this area here. And at the moment, if we're talking about today, and this is the high price, we're seeing resistance being met in this area here as well. So the reminder being, yes, we have a downtrend. What are trends? Trends are more likely to continue than to break. Remember that that's merely probabilities, not certainties. We always deal in probabilities. So when thinking about your process, you want to, just like we would with equities, we want to define how is it we would like to approach these positions. How do we want to be in it? Am I an aggressive? I start all of my trades on the most aggressive entrance and I go full position size, or am I the trader who just needs a little bit more confirmation before entering those trades? Either can be fine, everyone, right? It doesn't matter which way it is you like to go about it. What we want to encourage you to do is to define that first so that you are giving yourself the playbook to help make those decisions in the moment. And I think, JB, he's making a wonderful point here. Notice how the lows in this instance, they don't happen every day. These lows will play out for a day, 2 days at a time, then you get a bit of a bounce. And it's that bounce that will, in the midst of owning puts, it's that bounce that will test your mettle. It'll make you say things like, well, did I just miss my best chance to sell? Should I be out of this already? And you have to have the proper amount of investment dollars on the trade so that you can make a decision that does not involve your emotions, right? You all who hear me on these segments, whether it's options or equities, you've heard me say that a number of times. That's because emotions are the enemy of the trader. We need to be more disciplined than that. We need to be prepared and we need to plan for what can play out. All right. Now, let's go ahead and look at some examples. Let's jump into the Thinkorswim desktop application. We're going to start by a quick review of what we did last week. Last week, we had been looking at Apple as a potential call option trade. And I'm going to zoom in just to the price action of the most recent few weeks. And I'm going to put us back where we were. So a week ago today would basically be this candle here. I'll just draw a little line in at our low for that day. And I'm going to jump back to our monitor tab. And I've done a search to highlight this. So we picked up the the May 2, the call option that was set to expire last Friday. And unfortunately, in our process, as you can see, I don't have a sell order on my 210. The contract itself ended up expiring worthless. Now, that's because we closed below 210 at Friday's expiration. However, if I were monitoring this, unfortunately, I was not. I was live over there in the Denver event and working with some of you, seeing some people I'd not seen before and shaking some hands. Good to see you there, Dragon Rider. We did have an opportunity to be a seller at one point. Look at the high trade on the day of, let me make sure that I got this right. This is Tuesday, Monday. Here was Friday's action. So on Thursday afternoon, we got as high as 214.56. So that tells me that that option on Thursday was at least worth about 4.5 and close to 5. So I would have been looking to exit at a break even, probably at best. Doesn't look like I had a whole lot of alternative scenario here. Now, if I felt like Apple wasn't going to make that continuation into Friday's close, it may have made sense to cover. But one reminder for you, everybody, when thinking about being the owner of options, remember, you can simply say, the amount of money I'm putting on this trade is an amount I am comfortable losing. It's an amount of money I expect to lose. And therefore, the trader can say, I'm going to carry that trade through the end of its life. And because you can't lose more than you spend when you own the contract like that, assuming we don't get assigned or you don't automatically exercise, many traders will just say, I spent $5 on it, and if it goes to zero, that's fine. I said that's what my comfort was. I'm good with that. So some would say that that's the approach, and they're just going to stick with it regardless. The only reason I can come up with a seller on Thursday at the peak is the belief that you were going to run into resistance there. You could see my downtrend line. Okay. Now let's go back and talk about that put side. So could we have done better on that long Paul trade? I'm afraid we could have. It didn't work out the way we had hoped, but that's option trading. That's trading in a nutshell, isn't it? So let's look at some examples of potential transactions that might work out for the bearish trader, the long put investor here. So we have Apple on this chart. A day like today, it could be something where the trader says, hey, we're making a new short-term low. Could they be thinking about a put option? Certainly. After a rejection at the 50-day moving average and the downtrend line, if they didn't take on a put option based on this with the Friday move, which could have made sense, right? Because here we have Friday closing below the low of Thursday. The Thursday is the high day in our rally up there. Some traders may have taken a put contract, bought one on Friday of last week based on that move near the close, and those traders would have done okay for the next couple of days. We'll see how that goes. But let's see about a couple of other examples of stocks that are in scenarios maybe where the rallies that we've witnessed are about to potentially lose steam. Let's take a look at one in the semiconductor space. How about Micron here, everybody? So what's been happening with Micron? Well, looks like we had been seeing a potential area of some support, and we fell through it pretty aggressively at the beginning of April. Now, I think we all can recall as to why. That seems to fall in line with the tariff discussion, Liberation Day, etc. We see that we've got a little bit of an improvement in the price action here, but we are also below our 50-day moving average right there. We are below what once was former support, could easily be resistance now. And some traders might be looking at this as a potential setup. Now, could they be early to the trade here if they decided right now to set up a put contract? And some would say yes, because we've made this would be Friday's high trade could be the highest move in this pop. And if that's the case, then we would need to close below the low we made that day. That low is 79.10. So traders that are wanting to be bearish might want to see a close today under 79 on Micron to establish a bearish put option, a long put contract, okay? And then they might carry it only down to perhaps the 20-day moving average. I'll remove my line so you can see it. The 20-day is right there at 74, and we're trading at 80. So just a point to make here, everybody, that's still 6 points away, and many a trader could make that work in terms of both the move and the time frame, okay? So sometimes it's about evaluating the price action and then moving into your contracts and seeing if there's anything that makes sense. So let's quickly do that on Micron before moving on to another example. And we'll see if the series of strike prices and option in the open interest and volume might validate a trade here. Let's go into the trade tab. So we are remaining on Micron and waiting for data here, which should be loading momentarily. There we go. And we've got contracts for this week, probably too many here. Let's change this just to 20. This will be 10 up and 10 down from the midpoint. And I'm going to adjust my columns to Kev's defaults. And Kev's defaults incorporate some basic stuff for me. As you might see, I've got the ask and the bid. I've got a couple of Greek details, the theta and the delta. And I've got open interest and volume. So real briefly, as a reminder of what these offer us, volume is volume for today exclusively. Open interest is the amount of open contracts at yesterday's close of business. So we aren't yet calculating today's volume in open interest. Now, we do have contracts that are, well, nice and tight, so to speak, in terms of the bid and the ask. At the $80 strike price, we do have $1.95 by $1.99, only a 4-cent bid. But the 85 strike shows us a lot more activity there on this call side. Now, we're going to eliminate the call side so that we can limit what we see here, since we are talking puts today. So I'm just going to cheat by going into the option chain filter, and I'm going to say, show me puts only. And this way I can't really mess things up for myself, can I? Now I can start talking about what we really want to pay attention to, puts. So open interest on the puts, pretty substantial up here today at the 90 strike. And just real briefly, everybody, let's think about why is it you think that somebody would be owning or utilizing put options at the 90 strike? It's unlikely they are sellers up there. It's most likely they are long or buying those put options. But look at that delta, everybody. Delta of 94 cents to a buck. Basically, you're getting almost a $1 dollar for dollar move in this option contract for a $1 move in the underlying equity, in the price of Micron here. So that means that perhaps somebody is of the belief that Micron is going lower, and they are long some shares of Micron that they don't want to just protect by owning puts on, out the money. They want to own puts that are in the money, so that for, every dollar of downside, they're almost going to profit a dollar in upside in the put contract, right? Almost a 1-for-1 ratio. And that's why they might be considering that. So you have to be remembering the importance of delta. So let's just reiterate that, make sure I'm providing enough info for everybody. The delta, once more, can be thought of as the amount per contract that you're going to increase or decrease based on a $1 move in that underlying stock. Okay, so it also can be thought of as the percentage of likelihood that the contract in question is in the money at expiration. So when thinking about that 90 put, this is ultimately suggesting that there is a high likelihood, 94%, that the 90 put will be in the money. That is to say, price action in Micron will be under 90 at expiration this Friday. And given where we are, we're 10 points below it. I don't think many would argue with that idea, right? But that's the math behind it. So if you are a trader who wanted to protect the downside of a very large position, you might be looking to spend some money there, right? And that jumps off the screen at me, the amount of contracts today the amount of contracts held there in the 90 strikes. That's interesting. Now, in terms of volume today, perhaps those 79s are being traded actively, perhaps a little bit more from the speculation side of things because you have a low delta, a delta of only 39 cents, 39% likelihood of being in the money at expiration, only getting about 39 cents for a $1 move to the downside. That would be more speculative, it would seem. Okay. Now, because we aren't below the low of a high day in our chart, it doesn't seem like Micron's going to provide us quite what we're looking for there. Let's take a look in the same space. What about Cisco? Boy, it's almost an identical chart. We're at the 50-day moving average, 3 days in a row. The low today was below the low of our high day yesterday, and yet we're back up above it. It's too early for a lot of bears to say, you know what, I'm just not ready to go yet, right? I mean, you're not getting enough confirmation here. It could be that setup, but by no means ready to act. Everything we just said about Micron looks really similar with Cisco here, except that we are nearer the 50-day moving average in purple. Now, I could see it setting up and I could see it working, but without the proper signal, the bear trader might just be sitting on their hands for a moment or two here in Cisco. Let's move it on. Let's look at Dell. All right, now Dell is another one where we've seen some improvement of late, but we have also seen an inability to make a closing higher high. Our last high, legitimate high close was this one back here. And boy, if I tell you that the technical analysis is nothing but voodoo, you might believe me when you see that our high trade here was 95.72. Our high trade over the last 4 days, 95.20, 95.84, 95.64, today 94.62. Now, our high day was here, and our low that day is 93.84. We are right on it, everybody. Could today be the signal for a bearish trade or a put trade on Dell? It's a possibility. If you were leaning in this way, everybody, we could absolutely build that out. And by the way, you're right, Andy, I did not address earnings coming up. This is a big and great reminder. We looked at Micron. Earnings have passed. We're a ways out from the next one. But the Cisco one, yeah, we need to know that earnings are coming on Cisco on May 14, and that'll absolutely have an impact on price. And it could give the trader a reason to consider a time frame not to incorporate the earnings window, depending on how you like to do things, right? Are you the trader who wants to trade around earnings or the one who would prefer not to? So that's another reason for considering various series of strike prices. Okay, so we were looking at Dell, and because we are, well, one, I'm going to give you an example trade. So let's utilize Dell because we are below currently the low of, or at the low of the high day. We could very well be a little bit early in this establishment, everybody. But again, you know, I want to make sure that we have an example we can work with as much as anything else. The details around it are right on the level at this moment, but we're kind of dancing there. It could be fairly interesting to see how this one plays out. One other note from a technical standpoint, those moving averages with the downslope to them, like we're sitting on that 50, man, these downsloping moving averages, when we're above them, they don't tend to hold support as well as these upsloping moving averages. And that 20-day moving average down below certainly seems to make a little bit more sense from a support standpoint, given that we have kind of hit our head on a bit of a ceiling here. If I was going to take this line and back down to this zone and then extend that line to the right here, you're going to see that it all kind of comes together at that same level, doesn't it? Goodness, it's always interesting when this stuff lines up from a technical analysis standpoint. So this is a pretty notable spot. Isaiah, I want to apply that real quick. I think I've got that linear regression. I don't have it in here, but we're going to add it. Linear regression, 100 line. Let's just see how we are looking on a 1 year time frame with I've got a 1 year chart. I got this as a 2 year. Now you see what you're talking about, Isaiah, right at the midpoint of that linear regression. And that is simply just the line of best fit, so to speak, on a 1 year time frame. Pretty intriguing that it's banging its head on that same level, or intriguing that we've got all this confluence of information all at that spot. Pretty interesting stuff. Doesn't mean it has to go down, but if it doesn't go down, if it rallies through this level, well, then it would be a very significant development that would bear watching. But I could absolutely see bearish traders deciding in the moment, this is the one we're going to work with. And it seems to make some sense. So if we jump back to our trade page, trading at about 94, and we want to participate in the potential for downward momentum in Dell, the first thing that jumps off the screen to me, everybody, is the options number of contracts in open interest and volume today relative to what we were looking at before in Cisco and Micron. This is much less enthusiastic, right? So Dell just does not have the so-called juice that some of these other options we've looked at do have. So notice, and when I say juice, just a couple of things. Look, not only lack of volume, lack of open interest relative to what we saw, but look at the spreads. I mean, here we are, 94. The at-the-money contract is 14 cents. And we were looking at a few others where the at-the-money contracts were like a difference of 4 to 6 cents or 5 cents in between. So it just makes it a little bit more difficult for that, for the profit opportunity here. So if we wanted to buy a $94 put for, let's go out another week, just going to give us enough time for consideration. Now, see, that's a little bit better, right? 89, that tells me we got some interest at that $89 strike, but that's out the money, everybody. So somebody out there is truly speculating. So let's incorporate that into our trade process. So this is 1,500 contracts traded today. We'll look at that. And we will try, and again, because we've got a wide spread, we don't need to be a buyer at the ask. Let's go to the midpoint down here, which is now $1.27, $1.28, and we'll try to gain execution there in lieu of going to meet the market maker at their price. So let's go ahead and do a long purchase of one contract expiring next Friday the 16th. We're going to spend $1.30 hopefully to gain this position rather quickly. You'll notice our max profit is, again, a very substantial level, but that's just the assumption that the stock were to go to zero in the lifetime of our contract. Our max loss is only what we spend there, right? Yeah, Frankie, you absolutely could be right. They could be buying for protection, right? That could be a point where the trader is saying, yeah, we own the stock. We've been owning it for a while, and we want to protect our downside by owning put options. And under 89, we don't like the stock any longer. But as long as we have the right to sell the stock at 89, that trader hopefully is sitting with a profit scenario and can take action if need be. But yeah, you're absolutely right. It is entirely possible that they could be looking to protect a long position more so than potentially speculating. And when you consider that earnings fall on the 29th, the only issue that I have with that line of thinking, Frankie, is that they're not positioning for a known event, right? So they're thinking about, if they were thinking about positioning against the earnings window, then they would have incorporated a contract that would expire probably on the 30th of May rather than the 16th of May. So just another thought there. All right. Unfortunately, everybody, we are at time. I know that with my hiccup, technically, we lost a couple of minutes there, but boy, these classes go quick. Really want to thank you all for joining me, though. If you have an opportunity, click that survey link that's in the chat. Thank you, JB. And let's see if we can't get some feedback from all of you. I would absolutely love to hear from you. Let me know what else you'd like to see from this type of class. There's a good chance with Cameron's vacation on deck over the coming weeks that I'll have another opportunity to join you here for this one. So thanks for being here. Follow JB and me on X, James Boyd CS and Kevin Horner CS. And if you like the conversation, hit that thumbs up down below and give us some input on that survey link as well. We would appreciate it. Hope you all have a fantastic rest of your Tuesday, everybody. We look forward to seeing you all again real soon.